Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Good morning and welcome to today's webcast, IRS Form 990 Update. Before we begin the presentation, I'd like to introduce today's presenters, Pamela Alexanderson and Renie Burbank. Pam has been in public accounting since 2008. She has considerable experience in tax compliance and consulting, as well as unrelated business income and board governance, and she focuses on large multinational organizations, community charities, healthcare providers, and educational institutions. Renie has practiced public accounting since 1991, for which she worked in private industry. She focuses on tax consulting and compliance services for not-for-profit organizations, particularly healthcare organizations. And before I pass the line to Pam, let's get today started with our first polling question. That is, what type of organization do you represent? Association, foundation, healthcare, higher education, not-for-profit organization, Moss Adams employee, or other? And I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And we'll shut it down in 3, 2, 1.
Okay, so this is Pamela Alexanderson. I'm going to start the presentation off today, and it looks like we've got about half of the group is not-for-profit organizations, about 20% higher ed, 15% healthcare, and then about 10% foundations. So we do have quite a gamut of different types of not-for-profit organizations here, so hopefully the information that we're presenting today you will certainly find helpful. So we'll go ahead and get started. The agenda today, we're going to cover significant changes to the 2015 Form 990. Lucky for us, there actually aren't a lot of what I would consider to be significant changes in 2015. So given that 2014 saw a significant change to Schedule A, and since some of you out there may have not actually filed your 2014 Form 990 yet, we thought it might be a good idea to go ahead and review those changes once more just to make sure that you understand what's required with the new reporting in Schedule A. We will also be going over some changes to Schedule H for hospitals, and then a few small changes to the 990T, probably mostly credits and deductions that you may not be aware of. Then we'll switch focus a little bit and go into some of the IRS strategic planning for 2016 and their exam focus. Okay, so I'm going to go ahead and begin with Schedule A. And again, this is a review for 2014 Form Schedule A, but the biggest change in that year was Schedule A, as the IRS continues to monitor the activities of supporting organizations under IRC 509A3. The new and improved Schedule A, I guess if you want to call it improved, has tweaks on page 1, as well as brand new parts for supporting organizations in parts 4 and 5. So organizations not exempt under 509A3 as supporting organizations will see little impact to their filing requirements as a result of these changes on Schedule A. The rules for Schedule A require 509A1 organizations, which are those that are publicly supported, to complete Part 2 of Schedule A to prove that they are receiving more than 33.33% support from the general public. One of the nice things about this is that the IRS did clarify that Part 2 can be completed by other organizations that are not exempt under Code Section 170B1A6 to determine that they are publicly supported. If you are exempt under Code Section 170B1A6, it basically says that you are receiving a significant amount of your income from contribution income as opposed to program service. And for those organizations that are not receiving a significant portion of their income from contributions, but rather from program services, Schedule B actually has a special rule that allows organizations exempt under 170B1A6 to only report in Schedule B donors who provide more than 2% of total contribution support to the organization. So if you are not able to utilize that special rule, the IRS did clarify the instructions to indicate that those organizations under 509A2 may actually be able to fill out 509A1 schedule in Schedule A and therefore qualify for the special rule in Schedule B. And the reason that that's important is for those of you that are 509A2 organizations and have to report on Schedule B donors, all donors of $5,000 or more, that can be a significant amount of work for you to gather that information. So if you can prove that you qualify as a 509A1 organization, you can complete Part 2 of Schedule A, qualify as more than 33.33% supported, and then significantly reduce your workload with respect to reporting on Schedule B. Okay, so with respect to the 2014 changes to Schedule A, changes to Part 1 indicate which new sections the supporting organization must complete. The IRS has been kind enough to include definitions of the different types of supporting organizations, and these definitions are based on the relationship between the supporting organization and the supported organization. Type 1 is a parent-sub relationship. Type 2 is a brother-sister relationship where there is common control between the two. And Type 3 has two components, functionally integrated and non-functionally integrated. Type 3 receives the most scrutiny from the IRS since the basis of their exemption is due in large part to the duties performed for the supported organization. However, these organizations tend to function a lot like private foundations, but don't have to pay the investment tax and abide by all the other private foundation rules, which does open them up to more scrutiny from an IRS perspective. Additional changes to Part 1 include asking how many supported organizations the supported organization supports, so you do have to list them explicitly now, as well as some small changes in disclosing to whom and how you support your supported organization. For Part 4, this is now required for all supporting organizations. It does have 5 sections of yes-no questions. So if you got a bunch of questions this last year from your accountant asking you about your relationship with your supporting organization, supported organization, and how you're functioning, that's why. Part 4 is required for all supporting organizations, but not all sections of Part 4 are required for everybody, so it does get a little bit confusing. Section A is the only section that's required for all supporting organizations, regardless of the type. And the questions vary from how supported organizations are identified via governing documents like bylaws and articles of incorporations and such, to the exempt status of those supported organizations and their domicile. The section also covers details of transactions with disqualified persons, which are people like officers, directors, trustees, key employees, substantial contributors, and the like. Section B is required for Type 1 supporting organizations, and Section C is required for Type 2. Both of these sections are pretty short and sweet. I think they fit mostly on a single page and are primarily concerned with how the supported organization controls the supporting organization to substantiate that relationship between the two. Section D, E, and F are for Type 3 supporting organizations, with Section D applying to functionally integrated and non-functionally integrated and dealing with control similar to Sections B and C. So there's a lot of new rules out there. It's really important to review the instructions if you haven't already to understand what those are. And then Section E is explicitly for functionally integrated supporting organization, and the IRS wants proof that you're meeting the requirements of a Type 3 functionally integrated supporting organization. So whether that's achieved through the activities test, as a parent of the supported organization, or as support to a governmental entity, they want to know that, that you are behaving appropriately as they would consider it. The next section is Part 5. This is required only for non-functionally integrated supporting organizations. And you have to demonstrate satisfaction of a distribution requirement, which is very similar to what private foundations have to do. But you also have to demonstrate an attentiveness requirement. And these are not new requirements for non-functionally integrated supporting organizations, but this is the first time that the IRS is actually requesting a calculation of the distribution payouts to ensure the supporting organization is meeting the integral part test by fulfilling the distribution requirement. If you're a non-functionally integrated supporting organization and haven't been performing these tests on an annual basis, the Form 990 is now going to ask you to make sure that you are doing this annually. And it's going to be interesting to see what the IRS does with this information as they're collecting it over the last year and probably over the next couple of years, because the tax reform draft discussion documents do call for a repeal of Type 2 and 3 supporting organizations. So we'll see what sort of data mining they do with the information they get and whether or not they decide to pursue that further. Okay, I'm going to go ahead and hand it over to Renee, who's going to discuss Schedule H with us.
Good morning. So we're going to talk about Schedule H, but first we're going to actually focus on the final regulations, and they are the regulations underneath Internal Revenue Code 501R. And I'm going to give you a little bit of background that brought us to this point. So under the Affordable Care Act, Internal Revenue Code 501R was enacted in March of 2010. Until the release of the final regulations, the hospital facilities were reporting their community health needs assessment, financial assistance policy, limitation on charges, billing and collections, in accordance with proposed regulations, which were issued and updated in 2012 and 13. In addition, the Internal Revenue Service released revenue procedures along the way, and that helped clarification of the rules that the hospital facilities must adhere to. So, which now brings us to the final regulations. The final regulations underneath 501R were issued December of 2014. This brought a series of challenging adjustments that tax-exempt hospitals need to adhere to in 2015, definitely going forward to 16, 17, and 18, because we do look out 3 years. One of the examples that was provided in the final regulations was the concept of community. And so the IRS had given the hospitals a little bit of flexibility of defining what community really was and personalizing the community that they actually serve. Besides the fact that the hospital needs to identify significant health needs of the community, prioritizing those needs, and identifying internal and external resources to address those needs, the final regulations of 501R brought forth additional requirements. One of those requirements is the facility must, it's called solicitation, so they must solicitate input from at least 3 sources. Say, for example, they need to solicit one public health department or agency that has knowledge about the health needs of the community. They need to solicit input from medically underserved, low-income persons or population, as well as minority populations within the community. Community health needs assessment also includes the implementation strategy. These documents must be written, and the information that they receive from the solicitations, that must be included in the hospital's most recent community health needs assessment and implementation strategy. Both reports, as I mentioned, need to be written. They need to be adopted by an authorized body of the organization or the hospital facility, and they also must be made widely available. The Community Health Needs Assessment Report and the implementation strategy, they're very public documents, and they could be scrutinized. The next item within the 501R regulations is the financial assistance policy. This also must be a written document. There is regulations that require the financial assistance policy to explain the different types of financial assistance that's available underneath the FAP, including the free and discounted care, eligibility criteria for individuals to actually apply for the financial assistance. Also included in the 501R is limitation on charges. These charges are for individuals that are eligible for assistance underneath the financial assistance policy. They're also known as FAP eligible individuals. There is specific criteria that their hospitals can only charge them a certain amount, maximum amounts to be charged to these eligible individuals for emergency or medically necessary care. There are a few questions on the Schedule H that is relating to the charges that are for the FAP eligible individuals. Billing and collections. There's really no significant changes relating to billing and collections. There are exceptions, of course, but the takeaway on this one is the hospital facility may not engage in extraordinary collection actions before they take a reasonable effort to determine if the individual is eligible underneath the financial assistance policy. The final regulations do describe what reasonable efforts are extraordinary actions, and the timeline for notifying the individual before any collection actions take place. So when it comes to the Schedule H, there is, in 2014 and 2015, there was a significant change. I'm sorry, in 2014 there was a significant change in the Schedule H. As I mentioned, that the financial assistance policy, as well as community health needs assessment and the implementation strategy, they need to be written and adopted by the governing body. The community health needs assessment and the implementation strategy, there are questions number 4 through 10, and they are really focusing on how the organization makes the health needs assessment widely available to the general public, as well as going into question number 10 is focusing on the implementation strategy and how that is widely available to the public. 501R and reporting on the Schedule H, the hospital needs to indicate how the community health needs assessment and the financial assistance policy is made widely available, and they do give certain questions that they can answer, as in, is it available on the hospital's website? Is it available upon request without charges? Is it posted in the hospital in very conspicuous places? And different places throughout the hospital, organizations can actually describe on how they actually make those items widely available to the public. With regard to the implementation strategy, on line 9, 10A and 10B that appeared on the Schedule H in 14 and 15, for question number 9, it's asked for the tax year that the implementation strategy was adopted. On 10, the organization can either, one, post it on their website and give a URL, or they can attach it to the Form 990. After the final regulations were released, there was a couple of revenue procedures that were issued to provide clarification and guidance, additional guidance to organizations. One of those is Revenue Procedure 2015-21. And this really addresses how an organization, if there is some sort of admission that is minor, inadvertent, or due to a reasonable cause, will that affect or have a failure underneath the 501R regulation? So with this revenue procedure, the Internal Revenue Service had come through, and they had said that any admission or error will not be considered a failure if it was minor or either inadvertent or due to reasonable cause. These items, if it is minor, and it would not be considered a failure. And let me give you an example. If there was the posting of the community health needs assessment or the financial assistance policy, if it was on a poster and that poster had happened to fall behind a chair and it wasn't readily available, somebody had noticed it, they put it back on the wall, that is considered very minor and inadvertent. So therefore, that type of instance, according to the IRS, that was their example, that would not be considered a failure of the 501R. I kind of look at these as various violations, and I put them in 3 different categories. The first category is minor errors and omissions, which is not considered a failure, which we just explained. The second one is they're more extreme. Those are willful or egregious failures, and those are subject to a full array of sanctions, and organization may even be subject to lose their tax-exempt status. The third one is in the middle. So it's something that is, it's a little bit more than minor, but it's not an egregious failure. And these will be or can be excused if they are corrected and disclosed on the Form Schedule H, Part 6 in the supplemental information. The information that needs to be disclosed if the organization does determine that they have incurred one of these failures is they need to describe the failure, including what caused it, the facilities that it actually occurred in, the date that it was discovered, and if possible, the number of occurrences. Within the description, it needs to include the method that it was corrected, the date that it was corrected, how many individuals were restored to a position if the failure had not occurred. So this is just really, there is no real questions within the actual Schedule H. It is a disclosure requirement. So now this concludes my presentation for the Schedule H. I'm going to turn it back over to Pam and have her talk about some issues relating to 990T.
Okay, before we do that, we actually do have a polling question. And the question is, would you like to see a webcast specifically on Schedule A or Schedule H? And we've given you 4 options. One is Schedule A, one is Schedule H, maybe both, if you're unfortunate enough to have to file both, and does not apply. So we'll give you just a few seconds to complete that, and then we'll view the results. Okay, I'm going to close that in 3, 2, 1. Okay, so Schedule A, about 40% said yes. Schedule H, about 10%. Unfortunately, there's 20% of you out there that might have to do both of them, and then 30% does not apply. So one of the things we wanted to know about this is these are both very complicated but extremely important schedules. You can either get heavily penalized if you don't do it right via Schedule H, or you can lose your tax-exempt status if you don't do it right via Schedule A. So we may definitely take that into account in a future webcast. Okay, I'm going to go over just a few little nuances with the 990T. There really weren't a lot of changes with the 990T. The 3 things I'm going to go over here are just really extensions of deductions or of exclusions that were already in place. And one of the reasons I wanted to point some of these out to you is not specifically because of these particular exclusions or deductions, but I did want to just generally make people aware that if you're filing a 990T, it's obviously because you have unrelated business income. And I wanted to just alert people to read those instructions once a year just to see if they have added something or taking something away, probably more added something that you might be entitled to that you are just generally unaware of. You know, those of us in the tax-exempt area, having to pay taxes is not something that we tend to think about very regularly. And if you have to file the 990T, I wanted people to be aware of those kind of one-off credits or deductions that may apply to you that you're not taking advantage of. So the first one covers Section 179D, and that's a pretty specific section of 179. Section 179 talks about taking additional depreciation for taxable organizations. And Section 179D really talks about deductions related to energy efficient commercial buildings. So it is a little used section for tax exempt entities, but it is extended for property that's placed in service after 12/31/14. And the deduction provides a benefit for businesses that build or renovate a building that's energy efficient. So those of you out there that are building something or renovating something and you have UBI, you may be able to take advantage of this deduction, which the maximum deduction that you will get is $1.80 per square foot. There's a number of ways that a building improvement can qualify or even partially qualify. But the most lucrative of these would be the building envelope, your HVAC or hot water systems, or interior lighting. The Form 990-T is used to report rental income from debt finance property. And so if you have this type of rental income from a building that you've purchased or renovated, you may be able to utilize this little-known deduction. There are energy efficient criteria, obviously, that must be met, and there are several types of structures that we've listed here that it does not apply to. The next, more really is an extension of an exclusion, involves qualified specified payments. So generally, interest, rent, royalties, and annuities are excluded from unrelated business taxable income, or UBTI, for tax-exempt organizations. However, there is a section of the code that treats these otherwise excluded specified payments as unrelated business income if it's received from a taxable or tax-exempt subsidiary that is 50% controlled by the parent tax-exempt organization, to the extent that the payment reduces your unrelated income of the controlled entity. There was a special rule that was passed as part of the 2006 Pension Protection Act that provided for payments under a binding written contract or substantially similar terms that you might be able to exclude some of these payments. So we just wanted to make you aware that there may be an exclusion available to you for qualified specified payments that are received or accrued after 12/31/14. And then the next one is probably very little known, but might be available especially to those universities that are on the West Coast that might be doing something with American Samoa. But there is an American Samoa Economic Development Credit that was extended to years after December 31st, 2014 and before January 1st, 2017. And it provides an incentive for U.S. corporations to invest in American Samoa. It can offset a portion of tax liability, so if you have unrelated business income coming to you from operations in American Samoa, from business operations, sale of assets, or certain investments, you might be able to take advantage of that particular tax credit. Okay, so another polling question. Are dividends considered a qualified specified payment? Yes, no, or I don't know. I'll give you a few seconds to answer that. Okay. 3, 2, 1. We'll go ahead and close it. 22% say yes, 40% say no, and 43.5% say I don't know. And this 512B13 is the section of the code that covers this. It can be extremely confusing. And if you are receiving dividends, that will be exempt as a qualified specified payment from UBTI. So really only interest, rent, annuities, or royalties would be something that would be a qualified specified payment that you may actually have to pay tax on the income. Okay, next I just wanted to cover, these are not changes in any portion of the 990, but I did want to provide some general clarification on a couple of different items. The first one is definition of control of a non-stock corporation. And the reason that I think this is important is, and actually the AICPA as well, is that we believe some organizations might be misinterpreting the definition of control in the case of a non-stock corporation or a tax-exempt entity. According to the 990 instructions, there is control in the case of a tax-exempt entity or non-stock corporation when 50%, when more than 50%, I need to make that clarification, it's actually not 50%, it has to be more than 50% of the directors or trustees of that organization are either representatives of or directly or indirectly controlled by a tax-exempt organization. So a trustee or director is a representative of a tax-exempt organization if he or she is a trustee, director, agent, or employee of that exempt organization. and a trustee or director is controlled by a tax-exempt organization if that organization has the power to remove the trustee or director and designate a new trustee or director. So it's really important that you understand the definition of control. There's a lot more reporting that's required in the 990 if there is a controlled entity, and especially if you're receiving payments from a controlled entity. So it's really important to understand whether or not, as a tax-exempt organization, you do have a controlled entity or you don't, so that you don't do more reporting than is required. Okay, and the next clarification I want to make, and this is a very little used schedule, which is Schedule N, as in Nancy. And we also want to point out that we might want to make sure people are not using this particular schedule incorrectly as well. So there is a section of the core part of the form that asks whether or not the organization transferred more than 25% of its net assets during the year, which would be considered on the surface a significant disposition of net assets. And if you answer yes, then you have to complete Schedule N. The glossary of the 990 instructions can be very helpful in a lot of situations, and in this one, because the glossary for this particular Schedule N says that, more specifically, if the 25% change resulted from the ordinary course of business, such as grant making, then preparation of Schedule N is not required. So if an organization has been very giving for a particular reason in a particular year, and you lose 25% of your net assets because of that, you don't necessarily have to file Schedule N. So when in doubt and you're not quite understanding what the instructions say, go to the glossary for the 990 and look that up there and see if you can get some additional clarification of some of that information. So I'm going to go ahead and turn it back over to Renee, who's going to talk to us a little bit about some IRS focus.
Hello. Okay, so the IRS update, usually the IRS, or the tax-exempt government entities division, they actually they publish these work plans. And in 2014, they published a work plan. 2015, I didn't see one, but now they're publishing this for the 2016, and these are their new areas of focus for 2016. Some of these things are definitely internal, and some of them will affect, tax-exempt organizations. The first one that really affects the Internal Revenue Service internally is they were partnering with the Lean Six Sigma to improve their internal processes and procedures. They also were assigning the IRS determination applications, and that will be the Form 1023, 1024, 1028, any type of application of that source to get an IRS determination letter. Those applications were directly assigned to specialists. Cases were usually closed within 35 days, but they were closed in 35 days is because the application was incomplete. Usually they actually hold on to the application for 90 days, but their new internal processes saying, you know what, if this application is incomplete, we're going to go ahead and send it back, refund the money, and let the organization take care of it, and then reapply. The long-term projects, they're evaluating the new form that came out a couple of years ago, which is the 1023EZ process. They were looking to make the Form 990 available to the, it's called a modernized e-file format. And then, of course, this was the one that I like, simplifying tax forms. Okay, so anybody that has filed the Schedule H over the last 5 years, is that being really simplified? in my opinion, it has been expanding. It went from 4 pages to 8 pages to 12 pages, and who knows what's really going to happen in 2016, 17, and 18. So this is the one that I really like to see what's going to come out when they're saying simplifying tax forms. The next area of the IRS update, these 2 items that they have provided some information on definitely is for internal processes. They're building this knowledge library, and that is more for their specialists to research and find out, certain technical resources within this knowledge network. The risk management, this is areas of training within the Internal Revenue Service in order to determine to identify risk really at an office level or regional level. And then they're introducing the risk acceptance form. And this is a document for risk-based business decisions within the Internal Revenue Service, to my understanding. This one is this really affects external as well as internal, the data-driven decision-making. So the information that the Internal Revenue Service obtains is from compliance reviews, compliance audits, field examinations, determination applications. So the IRS is looking at these different types of resources in order to determine to determine what plans that are strategic areas that they may find risk of non-compliance. So when it comes to the developing the pilot process for analyzing the 1023-EZ applications, what the IRS has done is if the application is incomplete, they will return it within 60 days. They will refund the user fee, they'll send back the whole package, and they'll also put a letter of explanation. There was a revenue procedure that was introduced and published, was 2016-5, and that describes and lists actually the items that were substantially incomplete within an application in order for the Internal Revenue Service to really send it back within that 60-day period upon receipt. Tax-exempt bonds. So tax-exempt bonds, what the IRS has done recently is do some statistical sampling in this area, and this is to determine the high-risk area of noncompliance with the tax-exempt bonds. One other thing that was just released was a new notification requirement for 501c4s. And a 501c4 is an organization that is commonly known as a social welfare and a community benefit organization. So December 18th of 2015, the Congress actually enacted a new requirement for 501c4s. And these organizations need to inform the Internal Revenue Service within 60 days after they have been established and intended to operate as a C4. The IRS is still working on the implementation of the notification process, and then they are getting the processes in place, and probably some sort of application or some form that a C4 would need to file within 60 days after they have been established. Now, any organization that is a C4 that has been established prior to the December 18th of 2015, they need to notify the Internal Revenue Service within 180 days. That can be done either via a letter. But if they have filed the application for exemption, which would be a Form 1024, or they have filed the Form 990, 990EZ, PF, or a 990N, or any annual information return, that would actually notify the Internal Revenue Service of their intent to be a 501c4. The next section is for employee engagement. Definitely this is internal for the Internal Revenue Service. These are the 4 items that they have provided as within their work plan for 2016 to inform the public of what their intentions are for the employee engagement. Okay. When it comes to 2016, the areas of focus, this is to ensure the organization can enjoy, as what they put it, their tax-exempt status, to comply with the requirements and adhere to the federal laws. The strategy will be to they're really implementing these through those data-driven decisions that we just talked about, and with the intended goal that from identifying and addressing any of the high-risk areas for noncompliance, the items that they have identified that they're focusing on for, let's go with the dealing with the tax exemptions. This is for non-exempt activity. Private inurement are the 2 items that they have said that they're going to be really looking at and focusing on. The protection of charitable assets from self-dealing, excess benefit transactions, loans to disqualified persons. Within the tax gap, their issues are involving employment taxes, unrelated business taxable income. For international issues, it is looking at the oversight of the funds that are spent outside the United States and making sure the organizations, if they do have those types of funds, that they're filing the FBARs. Emerging issues, that's definitely issues including the enforcement of the 501R compliance. There is different ways that they're going to be gathering this data. That would be from the compliance reviews, compliance checks, correspondence, field examinations, to name a few. So that takes me to the question. Emily?
All right. Our final polling question for today is, has your organization received a compliance questionnaire or been the focus of an IRS examination in the past 3 years? And your options are yes, no, I don't know, or prefer not to say. And I'll give everyone a few moments. And just as a reminder, once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification icon at the bottom of your screen. And we'll close it down in 3, 2, 1.
Okay, so we've got 7% of people say they have received a compliance questionnaire, been the focus of an IRS exam. 74% say no, and about 17% say I don't know. So this is, the reason we wanted to ask this question is, as you all are aware, the IRS has definitely gone through a reduction in workforce and certainly lots of upheaval in the tax-exempt sector of the IRS over the last couple of years. And so one of the things that we are seeing is that they, as Renie even was alluding to just a couple slides ago, is they're really trying to have a renewed focus on their exam and questionnaire strategy so that they're not just randomly choosing people. So, you know, the idea, if you were to get a compliance check or even notice of an IRS audit, you probably have not been randomly chosen at that point. And we want to reiterate for folks that if you do get a compliance check questionnaire, it is very, very important to fill it out as accurately as you possibly can and send it back. Our thought is that if you ignore it, then that may trigger some further inquiry of you from the IRS, which may not be all that welcome. The other thing is that we are getting, they are telling everybody that there is going to be a significant focus in the coming years on unrelated business income tax, and not taking more deductions that are necessary, because generally I think it's about 90% of organizations that actually fill out a 990T actually don't pay tax. And that is not in common with the general tax-paying corporate public. Most of those organizations do pay tax. So I do think that we can see in the future those of us that work in the tax-exempt space really getting some very targeted compliance questionnaires or exams coming up. So.
Yeah, and if I can just add to that, when it comes to the tax-exempt bonds, we have seen the questionnaires really going out to the universities. And with the IRS, from what I've heard, is they are going to be looking at the tax-exempt bonds for hospitals. And those are 501c3 organizations, 501c3 tax-exempt bonds. And they may be using the information that they have received from the questionnaire that they got back from the universities, and may be applying those to the actual tax-exempt bond requirements for hospitals. So one thing, a food for thought to think about if you do have tax-exempt bonds, and I know some of the clients that are on the line, they do have tax-exempt bonds. So just to make sure that when you do, if there is a questionnaire that goes out to the hospitals, just to make sure that they are completed accurately, have somebody reviewed it, either your legal counsel or your tax professional, just to make sure that you get a second set of eyes on those. Okay, thank you.
All right, so thank you so much, Pam and Renee. We do have time for a couple of questions. As a reminder, if you'd like to ask a question today, you can enter your question in the Q&A box and hit submit. And our first question is, if a credit union merged during the year with us, do we have to file 990 on their behalf? If so, do we need to check boxes 31 and 32 of Part 4? If so, do we have to report individual loans, investments, and other assets, or can we aggregate like items?
Okay, I'll go ahead and take a stab at this one. Typically, federal credit unions are exempt, and so I'm not sure if your organization falls in that or not, but typically federal credit unions are exempt from filing a 990. So if you had a state credit union that merged with you during the year, and that state credit union had a 990 filing requirement, you do have to file a final 990 for that organization if they have fully merged in with you and that state-sponsored credit union ceases to exist. So if that's the case, you will have to file a 990 for them. You will have to go through those particular questions in Part 4, because their net assets would have likely gone to zero, perhaps, and folded in with your organization, and then complete Schedule N. So.
There is another form. It's an 8495. That is when an organization actually has merged, or there's an acquisition or a merger, and it's taking the really the balance sheet and the assets and saying what organization really got what. And that form is usually included in with the Form 990.
Great, thank you. It looks like that was the only question. You guys did a great job. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the resources icon at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now in the certification icon at the bottom of your screen. Open the icon and click in the lower right corner to download your certificate. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate now. A copy of your certificate will be mailed within 2 weeks should you have any difficulty downloading it now. Actually, it looks like we've got one more question here, so we can answer this before we close. and it is, would you be able to provide a future webinar on Schedule K focusing on hospitals? I think that's probably something we can keep in mind for our Moss Adams webcast, and thank you for the suggestion. It looks like that's our last question, so I'm going to push a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. We thank you for joining us, and we hope you'll join us again next time.